are in listen-only mode.
Hey everybody, Preston Bryn here with our first weekly roundup for the markets in 2017. This is for the first week in January through January 6, 2017. As you guys know, I have been off for a couple of weeks, just relaxing, clearing the head. I had pretty much cleared out my portfolio going into the end of the year. We had a great 2016, and I look for a really fun and exciting 2017. So one thing is, in this email, there is an offer for you guys. I'm finally opening up at the request of many people to follow our Secret Trader portfolio, which is what I run. And I'm going to be running a portfolio for account sizes from 25K up to 150K, so that covers most folks. You can follow along with my trades. I've got a year-end holiday offer that will end tomorrow evening. It comes to an end, and then you probably won't see it again for another year. But just based on how we did in 2016, it should cover itself very quickly. So anyway, it's a 50% off offer. I highly encourage you to check it out. You do not have to be a member of our user group to take advantage of it. Okay, so and for those of you that have been watching my free weekly roundups for quite some time, you know we're pretty accurate as far as where we think the market is going to go. And so anyway, take advantage of it after this video. Check it out. Now, let's kind of take a look at where we've been and where we're going. I've got the Emini S&P 500 futures up here, and I've had friends. 2016 was a very interesting year. Let me just clear the screen of a lot of this stuff so it makes it a little bit easier for you. The opening price for 2016 was right around this level right here. Right around 2037 was the opening price of the E-minis at the beginning of 2016. And as you can see, the presidential election, well, we just, we actually went below the lows in the presidential election, and then we just, we went right back up again. This was November the 8th. And you can see here, we've had a couple of existential events when we started the year right here, because there's the opening price right there. We had the late January, early February kind of move. I got everybody long right in this area here, and we rode it up very nicely. Then we had the Brexit move right here. The markets got it wrong, and then we moved up nicely here. Then we let off into this downward path right here into the U.S. elections. We actually went into the negative for the year on November the 8th, and then you can see we ended up at the highs as going through the end of December. So you could pretty much say from November the 9th through the end of December, which is about, what, 6 weeks or so, we had, or 7 weeks or so, we made almost all of the money, all that return for the SPX in the green was in the last month and a half. That was pretty much it for the year. So and this was the opening price right in this area right here. So we gave up a lot of the money in September, and then we went back into the negative on the election day, and then away we went like that. So for big money, it was a difficult year. A lot of big money, if they weren't long right at this point right here, they finished the year down. A lot of the big money got long right in this area here, and then they started cutting back as it started moving back, and then they missed out on this big run here. So it was a little bit of a difficult year. But that's kind of where we were. Now the issue is, where are we going? Well, this is a weekly chart here. And on this weekly chart, one of the things I wanted to show you on the E-mini is that we've got a high and a higher high here. We've got a cross here. We do not have a cross in the MACD here, but even if we do get a cross, we're almost flat. Not quite, but almost. We got a lot of downward pressure here. The dynamics of the market are going to change from 2016 to 2017. Right now, if you will recall, and maybe you don't, but at the beginning of 2016, right in this area here, volatility, we opened 2016 with a VIX around 20, 21 or so. And then it just got uglier as we went through the February 11th low here before we settled in and made our low for 2016, which was our 2016 low right around February the 11th. And then we've been working our way back up since. But volatility was very, very high or higher than average going into 2016. The other thing right in this area here is the Feds raised the rates one time, and they forecasted 4 rate hikes for 2016. We did not get a rate hike until right here. So we only got one of those 4. So it wasn't 3. We only got 1 rate hike for 2016. Remember, they forecasted 4 in December of 2015. Didn't get it. Now we got it right here, 1 rate hike, which was probably the most forecasted rate hike I think the Feds have ever done. I think the 30-day Fed Fund futures was forecasting about a 98% chance of a Fed rate hike. Really insane. Now we're coming into the new year with very low vol, okay? And what did the Feds forecast for next year? 3 rate hikes. Okay, and the big unknown is the Trump administration, some of their policies. There's a lot of geopolitical risk with the Italian vote coming up, the French vote coming up, the German vote coming up, the populist movement in Europe. We've got a debt issue in China. We got a yuan devaluation and capital flight issue in China. Japan seems to be a little bit more stabilized now, but we do have some issues that could be geopolitical and or existential in 2017. Now, coming into 2016, I said it was going to be the year of the currency, all right? 2017 is really no different. We made some good money in currency and oil in this year right here. And we're going to do the same thing in this year right here. Currencies drive interest rates, or interest rates drive currencies rather, and then that will in turn drive equities. Now the equity market has already priced in some more rate hikes. So what does this mean for 2017? How is this year going to be a little bit different? The big thing in 2017 is going to be earnings per share and a stronger US dollar. Okay, so these two things are going to start providing some headwind to earnings per share and valuations. We approach 2017 with higher valuations, okay, which means corporations, remember, we've had 5 years, we've had 5 or 6 consecutive quarters with declining corporate earnings and earnings per share, yet we've gone up over the past 5 years, dramatically so, because the interest rates have been at the bottom. Now interest rates start getting hiked up. If there is more fiscal stimulus to the economy, meaning infrastructure build out, tax cuts, incentives for corporations to bring money back to the United States markets, then you're going to see the Feds between a rock and a hard place, because they're going to be pushed to hiking the rates, maybe not 3 times, but possibly 4 times. So they may get their wish, but instead of 2016, it's moved out to 2017 as far as how many rate hikes they're going to do. They do that, and then earnings per share and the PE ratios are going to be forced downward, because there's going to be a competition for yield and money. So 2017 is going to be a great year. One of the things we do in the Secret Traders, we have a couple of core trades that we could care less where the marketplace goes. And we run these core trades and we make money whether the markets go up, sideways, or down. And it gets you out of the habit of trying to forecast where the market is going to be 3 months later or 2 months later. Even 1 month later, coming into this year right here, 2016, a lot of forecasts were folded and went home by the end of February. Goldman Sachs famously said, here are our 7 picks for 2016 at the end of 2015, and of those 7, by February the 10th or the 11th, they came out and said, we're taking 6 of those off of our list and we're selling them. That shows you how wrong they were. It just goes to show you that education, PhDs in mathematics, algorithms, all that stuff be damned. You're just not going to be able to get a lot of this stuff right. The only way, And the reason why we've been successful in our group is that we trade key price levels. Price action is king. We follow key price levels, key pivot points, and then we don't try and get the top or the bottom. If we're choosing a directional bias, we wait for key breaks and then we move from there. The other thing that we do is we balance our portfolio with a pretty good bit in the commodity market as well, because commodities are independent of equities. Commodities have been in a bear market for almost a decade or so, and I believe in 2017 commodities are going to be coming back. Remember, if inflation comes back, commodities are going to start to come back. There will be some headwind with a strong US dollar, but I think there's going to be some surprises in the currency market as well. So these are just some of the things we're teeing up as we kick off 2017. Now, if I take it back to a daily chart on the E-mini futures, let me put all my indicators back on here again. You can see here we hit an all-time high actually going in on Friday the 6th at 22.77, roughly an even round number on the E-minis, okay, 22.77. Where do we go from here? I've seen forecasts that we're going to move up another 5%. I've seen forecasts that we're going to pull down 5 or 10%. I've seen worse. I've seen better. You can see here on this daily chart, though, I told our members, I said, look, you know, we had a high here and a higher high here. We did not have any divergences in this case, so I said any pullback here is going to be met by buying. And now this should say a 2017 open price. That's where we opened for 2017, not 2016. I got to get that changed. But you can see here that we had this classic ABC pattern, and boom, we're moving up here like this. Now, we're going to start to set up possibly a little bit of a divergence from this high and this newer high here. So we've had a run, and the momentum has carried us. We made this run may continue through the inauguration, and then we may, you know, sell off after the Trump inauguration. We will see. But this is kind of where we're sitting right now on the markets. If we look at the other market that has just been, you know, it's really funny how the TV talking heads are really pushing this, is if we look at the Dow Jones index, trying to break that all-important 20,000, you can see the all-time high in the Dow Jones index actually got up to 19,999.63. You can see the 2017 open price of 19,872.86. You can see the 2016 low. You can see the 2016 high. Here's the 2017 high, 2017 low. So we're kind of trapped in this range. Again, no bearish divergence, so that says any sell-off is probably going to be bought. But we're riding the bottom of this upsloping trend line right here. If I take it out on a weekly chart, you can see this upsloping trend line, which we broke in the summer of this year. And then we eventually came and we made ourselves back up, and now we're running into difficulty again on this chart. So I do believe that the risk of a bigger move is going to be to the downside, but I think most traders realize that. But the big key is, you know, where are we going to go after we have a little bit of a pullback, and where can we go to the upside? I do believe that the downside, we've got more risk than the upside as far as a bigger range of movement. The other one is the Russell. If we look at the Russell, let's look at the cash index first. You can see in the Russell, we haven't made new highs in 2017. Remember, the Russell was trailing everybody going into the end of summer, coming into the end of the new year. The Russell was trailing everybody. And then we just went through the roof in the Russell in early November, and we caught up with everybody. You know, small cap, mid cap was where everybody wanted to be, and boom, we made new highs back on the early part of December, and then we've just backed off a little bit, but we're not declining any. Any move down is probably going to be met by a little bit of buying. So we're still bullish on the Russell, like we are on the E-minis, like we are on the Dow, but we're a cautious bull right now. We're very cautious. In fact, for our Secret Trader portfolio, I'm going to officially kick it off on this Monday. If you sign up, then you'll get into our session tomorrow night because we're going to go through, the types of strategies and trades that we're going to be doing. And I think last year we finished at an annualized rate of about in the high 40s, 40 percentile, 40% or something like that. So it's a pretty good run. I think 2017 is going to be very similar, but there'll be some different assets that we're going to be trading. So this is kind of where we're looking. But if we look at the All World Index, it's flat, guys. This shows you why the U.S. dollar is so strong right now. This is a daily chart. The U.S. dollar is the only pig with lipstick out there. They're still devaluing the yen, the yuan. The euro is still relatively weak, although we've had a little bit of a bounce. British pound still weak. The dollar is the only strong one. We're the only one where we're jacking up the rates. Everybody else isn't. I think that dynamic is going to start to change as we move through 2017, which is going to give us some great runs in the currency market. So we got to watch that very closely. The other area here is China. If we look at China, you can see right here, there's the 2016. I left the 2016 open price line on there. You can see we finished at the bottom here on 2016 for prices. Now, we didn't hit the 2016 low way down here, but we finished in the red. And now we're going to start down at this level here for 2017. But China is got some issues, folks. And China could always be one of those existential events that just sets the rest of the market in motion to the downside. You guys may or may not have recalled what happened August 21st over the weekend when China devalued the yuan unexpectedly, and the markets opened lock limit down, more than a 5% move in over 9 hours. To create that lock limit move. Really ugly. Volatility went back up into the 50s. The volatility moved from the low teens to 52 or 53 in about a 3 or 4 day period. It was the biggest move in volatility in the history of the markets over a short period of time. It was unbelievable. And we've always had that risk sitting out there. So you've got to be very careful. And speaking of volatility, if we look at the VIX, we finished this past Friday at 1132, right down in this area here. You can see the 2016 low, and this is kind of where we're sitting right now, down near the lows. And if we look at that existential event, there it was right there back in August. Look at how the volatility moved. Now, for those of you that are not members in our group or not in our Secret Trader, I use these zones of volatility to help just remind you of the levels of volatility and different option strategies that work best in some of these zones, right? When you're down in the green, you do not want to be an all the time credit spread trader. But just to show you how things can really flip on a dime, we were down here in vol down around 12 or 13, and literally in 1, 2, 3, 4 days, we made it up to 53.29. That is over a 40-point move, not percent, but a 40-point move in volatility, right? That is over a 350% move in just a few days, almost 400% move in 4 days in volatility. And it's up in the black area. It's not even a zone. It's my black swan. Because you can see here, I've got these labeled on my chart right here as zone 1, 2, 3, 4, and 5, right? So this gives you an idea, and zone 5 obviously is what I consider a black swan event. Once you start getting over the 50 area in the VIX, these are one-time events that catches the market off guard. You can see here back on the Donald Trump, right before Trump, we got up into the low 20s, nowhere near where we were before with China. And then back on June 27th right here, we're a little bit higher with the Brexit vote. We only got up to 26 vol. Again, nowhere near the 50s that we got with that Chinese devaluation. It totally caught the market off guard. Now, one other thing I want to show you with volatility. If we look at vol coming into this year, we're down around, like I said, our VIX is down around 1132. If we look at how we were coming into 2016, right? If we look at the 2016 opening for vol, we were up in this area right there, That was the 2016 open. So we were down around the 22 area, low 20s, when we went into January 2016. Okay. Now, if we come back to 2015 and we look at where we were with 2015, we opened 2015 with vol a lot higher as well. Looking back here, we were right in this area here. We were between 1750 and 20. Again, very high. And then we proceeded to kind of from there move down to this area, down this level down here, around the almost down to 10, really. Now, if we come back, it's a little bit different when we go back to 2014. You can see in 2014 when we opened the year, in 2014 going into or the year 2014, we were around where we were now. But then you can see we had that spike up to almost 21 VIX as we started going into January. And then we quickly gave it up and went back down again. And then we just had a couple of spikes and a couple of scares, you know, going towards the end of the year, right? Again, this is a weekly chart. If we look at 2013, looking at 2013, we kind of stayed down here. We did have a spike in January up to 20. Right? And then we went down and we had another spike and then another spike up to 21 before things kind of settled down a little bit. But we had these spikes. So the key is every one of these years, beginning of new years, we've had these spikes going all the way back to 2013. If we look at 2012, we opened the year at 20 in the VIX and then we gave it up a little bit going into the end of the quarter, and then boom, we had a spike all the way up to 25, okay? So I'm going back all the way to 2012. We've got these spikes as we kick off the year for these new years, right? So now we're starting here. Let's fast forward to today, where we are now, going into the weekend on this, let me put it on a weekly chart. Okay, a daily chart, just to give you an idea. So here we are again. We're down very low. We just kind of moved in here. So we can, if the past 4 years is any guide, which normally it's not, but it does give you an idea of what can happen. We're down around 1132, and every one of those spikes put us up in this area right here. So to get from here to here, we're going to have anywhere from a 3 to a 5% pullback, right, to get us up into this level up here. Not much more than that, just enough to scare the children, kind of flush out some of the short-term players as we kick off the year. So everybody's trying to guess, you know, not so much the volatility side of things, but, you know, what can happen. So I'm not going to be surprised if this happens. In fact, as we start laying trades on, we're going to start preparing for this. I don't know if we're going to top out at that level there that we hit at the end of October, which is around a 23 VIX, right at that area right there. I don't know if we're going to do that, but I do believe we're going to get a 3 to a 5% pullback before we really start rounding higher. Remember, there's a lot of existential events that can cause this to happen. I don't need to go through them. It doesn't really matter. Whenever it happens, if it happens, which it will, just don't know the timing, but when it happens, leave it to the TV talking heads to find a reason. For us, we don't care. We just want to trade the price action. And that's where I see the price action looking at. The bond market, you can see the bond market is attempting to make a little bit of a move up, but right in these areas up here, the higher the bonds go, the more I'd be interested to short them, but I'm not sure. Let's see if they can clear the 50 EMA. This looks like a 3, 4, 5 pattern. Elliott wave would indicate we're trying to form a 4 up there, and then somewhere down here, we'll have a 5 leg, right? And then we'll settle in, and then we'll, you know, do an ABC kind of choppy pattern down here. But this is kind of what we're looking at in the bond market. If we get a trigger to sell, this would be a good area to sell. But I think we're going to kind of hold this level for a bit and get a little bit more direction out of the Feds. Now, we do have earnings kicking off, earnings season for Q4 kicking off next week. Keep in mind that this is going to be the year, I think, of the stock picker. Last year, the year before, with all that money being printed, it did not matter if companies hit their earnings per share guidance or not. They kept revising down. PE ratios kept getting higher and higher. Why? Because interest rates were flat, 0%. So there's really no competition for money. You had to be in equities. Now, as the interest rates get more expensive and the dollar gets stronger, you're going to see a tougher road to hoe for earnings per share. Analysts have projected about a 14% bump in corporate earnings for 2017. If they don't hit some of these higher elevated numbers, you're going to see the PE ratios reduced, which is going to reduce the share price. So there's going to be competition for money next year. Currencies, we've got a lot of action going on in currencies, metals, and gold. We're going to go into more details on those on future sessions. We've played the meat market perfectly going into the Q4 of last year, going long some of those meat futures, and then we played orange juice and a few others really nice to the downside, made great money on those. We're going to be trading some futures this year as well in the secret trader. So guys, I'm back in the seat again. I had a nice couple of weeks off towards the end of the year and just relax in the first week. Some people like to trade the last week and the first week of the new year, more short-term trades for day trading or a 2 or 3 day trade. They can be very exciting. For me, I just wanted to wind down and take it easy. But now we're going to be back in the saddle on January 9th. So stay tuned. And again, check out the offer that we've got in this email. It's a very, very a good opportunity. I've cut the price in half just for this year-end offer, just to get some of you guys into our group as non-members following our secret trader. This will be the first year that I open it up. All right, everybody, have a really great weekend. And let's stay tuned for the football. We got the football playoffs and so forth. So it's going to be a lot of fun over the next month or so. Take care, everybody. Ciao.